Hello everyone, today is Thursday, June 29th. This is your USAGold Weekly Review and Outlook. I am Jonathan Casares with Peter Grant, as always. Here we go again. We're going to kind of pick up on some of the themes that we initiated last week, do a little discussion there. But first things first, gold and silver prices still very much range bound. Not a whole lot going on. I do want to make a quick conversational point about the fat finger trade that occurred earlier in the week. Where there was a massive dump of billions of ounces of gold, just a huge contractual dump. Basically, they called it a fat finger trade. I guess the volume was equal or even greater to that of the volume on presidential election night, which caused, extraordinary volatility in the market. And so I thought it was interesting that you have this huge trade that was not immediately unwound, by the way. There was no oh no, immediate unwind spike in the chart. I mean, it actually went down. It tested those lows in the 1230s or low 1240s, and then kind of came back up from there pretty quickly. Here we are, mid 1240s after all of that. But yeah, it didn't have the impact to the market that other such trades have in the past. I thought that was interesting.
Right, and what I always find interesting, if it's an error, one would expect errors to be equally divided between buys and sells, wouldn't one?
Wouldn't.
Why are they always sells?
I don't know. I hear you though.
Yeah, so I'm a little bit skeptical about the whole fat finger thing. But this time around I was impressed with the resiliency.
Yeah.
It held above the 200-day moving
Exactly.
average, retraced all of that, and then is off again a little bit more defensive today, back within the range. As a result of higher yields.
Yeah, exactly. But still, stable, I guess, would be the large takeaway on price activity for both, is that we're just very much range bound, very stable here. The quiet days of summer heading into the 4th of July. But I thought that was particularly fascinating because years past, you see a dump like that, breaks through all the stops, everybody runs for the hills, and this time around it just didn't. It was interesting to see. And even if it was the dreaded M word, manipulation, it sure didn't work, did it?
No.
And I think that, even if you believe in gold price manipulation, ought to be a positive sign in that department. So, but moving on from the basic price activity, and kind of returning to the themes that we discussed last week, I'm going to kind of keep going on this because Pete posted a great article this week from Egon von Greyerz that I think everybody should read. Title was "Hubris Kills Whilst Gold Protects." And he really touched on some of these notions of hubris that we're going to kind of jump into today, which is kind of like we were saying last week. This notion that everything is fine, everybody thinks everything is fine, everybody thinks everything will always be fine. But you're starting to see more and more people talk about, hey, kind of talking about how everybody thinks everything is fine, but not necessarily that it is.
Well, the market's memory is short, and people's memories are short. In terms of bad events. I mean, it's been 9 years now since, the recession ended and the financial crisis is far in the rearview mirror, and everybody thinks that policymakers the world over have successfully managed us back to stability, and nothing could possibly ever go wrong again.
Ever again.
In fact, and I think this is your point, and that Janet Yellen actually said that she didn't expect another financial crisis in this lifetime.
I don't know. Is she talking about her life? I mean, is she planning on kicking it in the next few years? Or what's going on here?
Well,
that's such a broad statement and so overly hubris in terms of, how could you possibly say such a thing?
So I contend that the Fed specifically is trying to manage interest rates higher, to tighten policy, and to foment confidence in the markets and in their ability to ward off anything bad happening, so that they have sufficient clearance in the Fed funds rate to manage things when something bad happens.
Right. But it is that belief that they can manage it, that they can just do it, where there will be no problems,
Right.
even if they manage it the same way. It's like, we'll never be presented with as big of a problem as we just had. And look, we succeeded in fixing it. Succeeded being a operatively quoted word, because success is variable at best, and I'll get into some statistics on that, because it has not been a universal success. I mean, they may have prevented a complete collapse of the economy, but it is not a broad recovery like they have described.
Well, no, I would absolutely agree with that. And everybody pretty much will concede that the Fed needs at least 300 basis points of easing in the event of a recession. Right now, they've only got 100 basis points, basically, if the recession were to happen, tomorrow.
Right.
They would like, I think at this point, to continue raising rates, but the market's not buying it for September. So it had been hovering around 12% probability of a September rate hike, and I think the Fed absolutely wants September on the table. And so they are going to say whatever they have to say to convince the market, up to and including nothing could possibly go wrong in our lifetime.
It's so grandiose. It's almost absurd.
It is, but it moved the needle.
Yeah.
It's 18% probability now.
Yeah.
So they moved it, 6 points on that probability scale, and they'll continue to do so, I think, in the weeks and months ahead leading into the September FOMC meeting.
It's extraordinary. And I mean, and to the point, and this is more of a close to home, if you will, notion, is there's been a lot of talk lately because the first quarter debt numbers came out, and household debt is at a record level. Worldwide debt is at a record level. I mean, just some basic statistics that are really kind of interesting. So right now, total outstanding household debt here hit nearly $15 trillion in the first quarter, which is considerably higher than it was even in the build-up to the Great Recession. Global debt is at record levels. G20 non-financial debt stood at 220% of GDP, which is 40% higher than it was in 2007. So we're talking about massive expansions in debt. But then I was watching this program, and they said, but it's not nearly as dangerous as it was during the financial crisis, that the household, or the mortgage debt, was so much more dangerous than household and global debt.
Well, arguably that's actually backed by an asset. And while during the financial crisis it was a falling asset, but there was still some backing there at least. The debt now is largely consumer debt. It's
right.
Credit cards, it's auto loans, it's student debt.
Student loans, exactly.
Where you're not really backed by, there's no collateral there.
I'm trying to figure out how that statement could have been made with a straight face, but it's the same hubris. It's the same idea that, well, this time it's not nearly, and even household debt, I mean, this was like, kind of like a are you kidding me statistic that I read. So outstanding home and mortgage debt in 2007, 8, and 9 sat north of $10 trillion. And now it's currently $9.8 trillion. So now it's like, I mean, percentage-wise, it's barely less than it was at a higher valuation of housing. And so, I mean, are we not, even if you wanted to say housing debt picture looked that much better than it did in 2007, and the financial crisis isn't going to stem from the exact same location, how could you possibly argue that we are that much better off when the total debt burden is roughly the same?
Now that statement makes zero sense in my mind.
Exactly.
We are more leveraged today than we were in the months and years leading up to the financial crisis.
Substantially more so in many different areas than last time.
It's not just localized
exactly.
to U.S. consumers. It is global in nature. Everything from credit card debt up to central bank balance sheets.
Exactly. It's so stunning to have such hubris as to believe that things are that much better off now, that we could never have a crisis again, when you literally can point to any sector of the economy and point to debt burdens being far worse than they were last time we encountered this.
If I were a contrarian,
If
I would say we were on the cusp of something really bad happening.
Well, it's stunning. And I just want a couple more statistics that I found as I was kind of doing some research for this video that I think are interesting and speak to the hubris or the lack of planning. So this is speaking about Americans and income levels. And this also, it also speaks to the breadth of the recovery. We've covered this countless times, that the recovery has benefited the 1% over and over. It has not benefited the whole economy across the board. And in fact, median household income remains within a 1% level of where it was in 1989. I mean, you're talking like, nearly what, 30, is that 30 years later? Yeah, nearly 30 years later now. And median household income has not grown. And yet, despite even the low inflation numbers that they say are there, which, are probably underreporting actual inflation, means that people are making less and less and less relative to the things that they need to buy, which means people are living in greater and greater debt, which speaks to all of the numbers that we just discussed. But even just more statistics to the point. 61% of Americans do not have enough money saved to cover 6 months of living expenses. 49% of Americans are currently living paycheck to paycheck. 68% of all respondents' investment strategy does not account for a recession. 68%. 7 out of 10 people do not account for a recession. They do not plan on it in any level. Hubris. 64% of Americans do not have secondary sources of income. So you're talking about literally, I mean, it's everywhere. It is pervasive. The hubris isn't just at the central bank level. It is at the individual level. And I don't know if that's hubris at the individual level or just not even really having a choice, which is what I really think it is
That's
more.
probably more likely.
But it's still this notion of this dependence on the system and the stability of the system. And the dependence is on a razor thin blade.
I would agree with that. Absolutely.
So I mean, like, how can you say never have another problem? I mean, it's stunning to me. Stunning to me. So one more little quick point, and then I'm going to jump into some von Greyer's quotes here from this article. But one last one, because we've been talking about stock market overvaluation. I just came across this one too in the context of my research here. Stock market capitalization as a percentage of GDP is at its highest in history. It's around 150% of GDP. The average over the last 50 years or more, 77%. Double.
Sounds pretty frothy to me.
Frothy indeed. All right. This is kind of I pulled a couple rather long quotes here, so bear with me. But there was so much in this article. Honestly, if you ever wanted a reason, long-term fundamental reason to buy gold, really a big picture look. This was a great read. It's available at our forum. We'll also link it, with the video here. But jumping right in, here's what he wrote. Long term, no one has ever got away with creating a system based on fake money, unlimited debt, zero or negative cost of money, with the government and the bankers being the main beneficiaries. They will, of course, not succeed this time either, but the power and massive wealth created by a small elite make the powers that be so corrupt and so arrogant that they can't even see the consequences. Our friendly central bankers will stand by and print unlimited amounts of worthless fiat money, but this time it won't work. The printed money will not save the system, but only create inflation, leading to hyperinflation and eventually a collapse of the financial system. Then he goes on to make a prediction for gold, which he often does. But he goes, just like in the 1970s, physical gold and some silver will protect investors from the ravages of inflation. At that time, gold went from $35 to a high of $850, or up 24 times. A similar increase this time would take gold over $6,000. But history won't repeat itself, but it will rhyme very nicely. This means that gold will go up substantially more than the 24 times due to the massive amount of money that will be printed to cover the 2.5 quadrillion of debts, derivatives, and liabilities. It will be impossible to forecast the level, but it could be the $150,000 or $2.6 million level, as I discussed in my article last week, or it could even be $100 trillion, as in the Weimar Republic.
Yikes.
Get you some gold. Egon von Greyerz. Thank you very much for watching. I'm Jonathan Casares.
I'm Peter Grant.
Happy 4th of July, everyone.